Imagine a company so trusted, so celebrated, that Wall Street analysts called it the smartest business in America 6 years in a row. Its stock soared. Its executives were treated like celebrities. And then, in less than a month, it completely collapsed into nothing, wiping out $74 billion in shareholder value and destroying the retirement savings of thousands of ordinary employees. This is the story of Enron, one of the largest and most audacious frauds in corporate history. To understand how Enron fooled the entire financial world, we have to go back to the 1980s, when the company was formed through the merger of two relatively boring natural gas pipeline businesses. For years, Enron operated exactly as you'd expect, a solid, unremarkable energy company delivering gas through pipelines across America. But in the 1990s, under the leadership of CEO Kenneth Lay and an ambitious new president named Jeffrey Skilling, Enron transformed itself into something entirely different. Instead of simply delivering energy, Enron began trading energy contracts like stocks, essentially turning itself into a financial trading company disguised as a utility business. On paper, the results looked spectacular. Enron's revenue exploded from under $10 billion to over $100 billion in just a few years, making it one of the fastest-growing companies in American history. Fortune magazine named Enron America's most innovative company 6 years in a row. Investors couldn't get enough. Wall Street analysts practically begged their clients to buy Enron stock. But underneath this dazzling success story was a company built almost entirely on accounting fraud. Enron used a controversial accounting method called mark-to-market, which allowed them to record projected future profits from long-term contracts immediately, even if the actual cash hadn't been earned yet. In simple terms, if Enron signed a 20-year energy contract, they could book the entire projected profit from that contract as revenue on day one, regardless of whether the deal ever became profitable in reality. This gave Enron executives enormous power to manufacture profits out of thin air, simply by making increasingly aggressive and unrealistic projections. But even that wasn't enough to hide the company's actual financial problems. So Enron's leadership, led by Chief Financial Officer Andrew Fastow, created an elaborate web of thousands of secret shell companies and off-the-books partnerships. These entities allowed Enron to hide billions of dollars in debt and failing investments, keeping them completely off Enron's official financial statements. To investors and regulators, Enron looked like an extraordinarily profitable, rapidly growing company with a clean balance sheet. In reality, they were drowning in hidden debt propped up entirely by fraudulent accounting and blind faith from Wall Street. For years, this house of cards somehow held together. Enron's stock price kept climbing. Executives cashed out hundreds of millions of dollars in stock options. Employees were encouraged, and in many cases pressured, to invest their entire retirement savings into Enron stock, being told repeatedly that the company's future had never looked brighter. Then, in the year 2001, cracks began to appear. Journalists and financial analysts started questioning how exactly Enron generated its massive profits, since nobody could clearly explain the company's actual business model in simple terms. As scrutiny intensified, Enron's stock price began falling. Executives, sensing the unraveling truth, quietly began selling off their personal shares while publicly reassuring employees and investors that everything remained financially solid. In October of 2001, Enron was forced to admit a shocking financial restatement, revealing hundreds of millions of dollars in previously hidden losses. Confidence collapsed almost instantly. Within weeks, Enron stock, once trading at over $90 per share, crashed to literally pennies. On December 2nd, 2001, Enron officially filed for bankruptcy, at the time the largest corporate bankruptcy in American history. The human cost was devastating. Over 20,000 employees lost their jobs overnight. Thousands of workers who had trusted their company's promises watched their entire retirement savings evaporate, since many had unknowingly invested almost everything into now worthless Enron stock. The fallout extended far beyond Enron itself. Arthur Andersen, one of the 5 largest accounting firms in the world, collapsed entirely after being found guilty of destroying documents related to Enron's audit, putting tens of thousands of additional employees out of work who had nothing to do with the fraud itself. Kenneth Lay and Jeffrey Skilling were eventually convicted of multiple counts of fraud and conspiracy. Lay died before sentencing, while Skilling served over a decade in federal prison. In direct response to the scandal, the United States government passed the Sarbanes-Oxley Act in 2002, fundamentally reshaping corporate accounting regulations and executive accountability standards that companies still follow today. The Enron scandal remains one of the most important cautionary tales in modern financial history. It proved that even the most celebrated, seemingly innovative companies can be built on nothing more than elaborate lies, and that when profits seem too good to be true, they very often are. So here's a question for you. Do you think stronger regulation could have prevented the Enron scandal entirely? Or will there always be another company willing to push the boundaries of fraud as long as the rewards are big enough? Let me know in the comments below.